Well, welcome everyone. We are on week 3 of the 4-week free entrepreneurship funding program. So week 1, we learned about business plans and we actually worked with you on developing at least the core of a business plan. In week 2, we turned the page and we talked about the formation of the business. What needs to be in place to really have the foundation of a business to be able to dress it up, if you will, and make it fundable. Everything from the address to the entity filing with the Secretary of State, the EIN, and then the bank account. So now we're on to week 3. Week 3, as shown here on the screen, is about business credibility. Now, please note, we're talking about the business's credibility. We're not talking about the business owner's credibility. We're talking about the business's credibility. Now, you might be quick to say, well, wait, if we just formed this business recently, maybe as recent as last week, if we did that with you after week 2, how could a brand new business be credible? It doesn't seem possible. This must be non-applicable to me. That's not true at all. So we're going to go through and talk about what business credibility means, the different components, and also what can be done to legally improve, to manipulate, if you will, legally and ethically, the credibility of the business. So when we talk about business credibility, we're going to talk about the 3 C's. And you might have heard of this before. It's common business knowledge because we talked earlier, we need to put our mindset on business mode when we're working together. We're not talking about personal financial literacy. We're talking about business financial literacy, things that impact us as an entrepreneur. So as stated here on the screen, the 3 C's are important because lenders use these factors to determine whether to approve you for a financial product. Now, when we say financial product, there's lots of different financial products, aren't there? There can be business loans, business credit cards, business lines of credit. Maybe we're trying to get equipment financing. Maybe we want to buy real estate. There's many different types of extensions of credit. But when we're wanting to essentially borrow money, either straight out borrow money or borrow money to purchase something, these are some key factors to keep in mind. So lenders use these 3 C's, credit, capacity, and collateral, and we'll break each one down to determine if you're approved or not, and also determine your rates and your terms. So at the core of having a credible business is this term called the 3 C's. And we're going to dive into each of those today. Today, we'll talk about them. And then between now and next session, we'll work with you on evaluating your 3 C's and strengthening them if they need. So we'll learn about it, and then we'll act on that knowledge between now and next session. So let's use the first C and discuss it, and it is credit. Now, please realize that there are 2 types of credit. There's personal credit. So personal credit is often what most people think about. You probably have free credit tracking on your different credit cards, or maybe you have it through other services where you have a FICO or a Vantage score, and typically a 680 or above is considered a good score. 720 or above is considered a really good score. But let's focus more on business credit, business credibility. Okay, so there's a difference between personal and business. The nature of what you and I are working on is business credit. It operates actually much differently than personal credit. But in general, what is credit? Credit is a reflection of how obligations have been paid in the past. Now, I know life can happen and circumstances can be beyond our control, but all of that is kind of narrative that's pushed to the side. The bottom line is our credit history, talking about our business, the credit history of our business tells how we've paid our bills in the past, And no one has a crystal ball. No one knows what the future is going to be. No one knows if anyone will pay their bills on time in the future, but it's the best predictor that lenders have of what we'll do in the future. Now, we're going to talk about how we can build business credit in just a moment, but we'll postpone the intervention until we get through a couple more bullets. Now, in terms of personal credit or business credit, we'll see on the third bullet, there are many different lenders and different loan programs, some of which look at both personal and business credit, some only look at one of the two. And there's, in fact, some types of funding, believe it or not, that do not care about either type of credit, personal nor business. So it can vary, but in general, what would we want to do? If we're a responsible person, if we're a responsible business owner, we would want to have a strong credit profile for our business, and frankly, also a strong credit profile for us as a business owner. You might ask, well, how do we measure credit? Well, you probably know that answer already, right? Credit is measured by looking at credit reports. So there are different bureaus. For personal credit, it's mainly Experian, Equifax, and TransUnion. There's a different set of business credit bureaus led by Dun & Bradstreet, and then Experian Business and Equifax Business. But don't miss the details of what I said, the nuance. You might say, oh, well, he said Experian and Equifax here, and then he said Experian and Equifax here, so those must be the same. No, they're different divisions. They're different. So there are other bureaus for personal, and there are other bureaus of business. But the big three of the business side, which is what you and I most care about, it would be Dun & Bradstreet, which gives you a PAYDEX score, PAYDEX, a PAYDEX score. Business credit scores typically run from 0 to 100, and 80 or higher score is preferable. There are some lenders that look at a hybrid, and that's called FICO SBSS, Small Business Scoring System. That has a different credit algorithm that incorporates both, and a different scoring model. So it actually goes from 0 to 300. So normally a 160 or higher is what we'd want to have on an SBSS. A lot of details there, but the goal today is just paint a big picture on what does it take to have a credible business. 3 C's, credit's the first one, that's the one we're on so far. And we're going to help you look at your credit profiles, understand if they're strong. If they're strong, great. If they're not strong, we're going to look at strategies, but obviously legal strategies to improve them quickly. Credit doesn't have a memory. Credit is fluid. Even if credit's not so great at the moment, that doesn't mean that we're stuck there. So there are 3 C's when it comes to business credibility, of getting funding, of getting financing, of getting loans, and credit is one element. There's personal and business. We're going to focus primarily on business, and we'll have an in-depth one-on-one to look at where you're at, both on the personal, frankly, and business side, see if there's any improvements that need to be done. Are we good there? Okay, so let's move on to the second. So that was the first of the 3 C's. The reason that this module is built around this is a big deal, right? We can't just have finished the business plan in week 1, and in week 2, we set up our entity, we have our address, we have our EIN, we have a bank account. We're just ready to go to funding. Not at all. We need to look at our 3 C's. Again, not all lenders use all 3 C's. We have to have at least one of the 3 C's to get funding for sure, but to have all 3 strong is our best case scenario to have the best access to funding. Let's move on to the second C, which is capacity. We'll scroll this on up. So capacity, sometimes referred to as cash flow, measures the borrower's ability to repay a loan based upon historical and projected financials. So there's a lot of important words in that. So capacity means cash flow, It's looking at whomever wants to borrow the money. So if we're talking about a business loan, then it's talking about the business's ability to repay that loan, looking at both what has happened in the past and what we project to have in the future. So these are two different time frames, right? Historical financials are where we're running, for instance, we could look at bank statements of the business or put together a P&L, profit and loss, also called income statement. So that's history in the past, and then projected is going forward what we anticipate to happen. The obvious reason, probably, that to you and to I both, of why this is important is that lenders don't want to offer loans to businesses that can't afford to repay it. Now, that can be a bit of a confusing statement, because you can say, well, if we just formed a new business a week ago, how have I created any historical financials in a week? Well, that's true. That's true. We can't, everything we're going to do is legal and ethical, so we can't make up anything. But there are some strategies to quickly create historical financials, and we can help you with that. And then, of course, then we'll create positive forward-looking or projected financials. So the combination of how things have been in the past and or how we project things to be in the future is going to have a tremendous impact on the lender's willingness to loan us money or extend us financing. So this C focuses on your annual revenue and cash flow. And the truth is, they can be very much interested more than just annual revenue. They may even look at it down on a monthly basis. The reason that they care about this is, can we afford to pay back the loan that we want? We've recently been working on a large loan with a client that just recently wrapped up. And his monthly payment for his loan is $63,000 a month. Now, you might say, well, that's too much. Well, that's what the payment is. He wants to borrow millions and millions of dollars, which is great. He needs it for his business. We've been able to document that he can afford to repay it, so that's not a hurdle. But of course, when we're looking for loans, the expectation is we're going to pay back those loans. And so we need to document that we can afford it. And that's through our historicals and or our projections. So that's where I mentioned it's looking at bank statements, financials, and projections. Again, as we've said earlier, not all lenders have the same requirements, but with that being said, there certainly are some lenders that will fund pre-revenue businesses. So what does that mean? I want to avoid using the word startup. A lot of people want to use the word startup, but in the lending world, startup technically means, especially the SBA lending world, means a business 2 years or less old, where a lot of people think of startup as something less than that or something inconsistent. You and I will use the term pre-revenue. So if we're not open for business, we don't have customers paying us, we're not making money yet, then we're pre-revenue. Can a pre-revenue business get funding? Absolutely. Is it better to have post-revenue? Is it better to have a business that has cash flow coming through? Of course. So that gets us to this final bullet, which is incredibly important. So just like we said on credit, if credit isn't strong, we have legal ways to improve it quickly. Same here on capacity. If capacity isn't strong, we can first build strong projections, and that's important. But we also can start adding deposits into your business account. We call that the opportunity fund. So we can start getting deposits into the business right away, even if the business is new. You might say, well, how much deposits do I need? There's not set rules on this because there's different lenders, different loan programs, and then different sizes of loans. But our goal would be to work with you to document at least 5 to 7 deposits, 5 to 7, sorry, 5, if I could quit clicking somebody, 5 to 7 deposits per month, totaling at least $10,000 a month. That's what we would like to see. Will that always be enough? Depends on how much you want to borrow. Could we do less and still get approved? Of course, but in general, that's what we'd like to have and we can provide those deposits for you if you need. So that's 2 of the 3 C's. So now we're down to the third C, which is collateral. So collateral gives the lender the assurance that if the borrower defaults on the loan, that the lender can get something back. Now, a lot of people say, oh, what about PGs, personal guarantees? Or some people say, well, I don't want to PG my loan. I don't want to be responsible for my business paying its bills. Well, those are different circumstances. Some lenders will require a PG, some won't. But that's really not what we're talking about here. We're not talking about what you as the business owner are bringing to the table. We're talking about specifically what's on the balance sheet of the business. Now, yet again, you might come back and say, whoa, whoa, whoa. It was just a week ago that we formed this business, right? And we're talking about cash flow for a brand new business that's a week old. That's true because we want to get cash flow going as soon as possible, but that's not the point we're on. We also want to get collateral on that balance sheet as soon as possible. And as mentioned here, there are legal ways that we can get assets on the balance sheet for a brand new business. And that's typically what we like to do. If we formed the business with you last week, this week, let's make the balance sheet strong. Now, again, we're playing by the rules. So when I say these strategies, I don't want you to wrongly interpret, oh, that sounds fuzzy. No, what we will do, and we normally do, is transfer accounts receivables to you to put on your balance sheet. So let's talk about this a little more. So what's on a balance sheet? The business's assets and the business's liabilities. Assets are the things that the business owns. Liabilities are the debts that it owes, O-W-E-S. So let's say that your brother-in-law owned a piece of real estate and your brother-in-law wanted to give your business the piece of real estate. Can he do that? Well, sure. There's no law that prevents your brother-in-law from giving you a piece of real estate. Well, now you own the real estate in the business's name. It would show on the balance sheet as an asset, wouldn't it? Well, that's not what we're doing, but that's an analogy. So what we're providing you, it's not real estate, but we're providing you a different type of asset that's actually even better than real estate. It's called accounts receivables. So these are real receivables, real debts that will be owed to your business by the debtor. We transfer those over. Those go on the balance sheet to show assets. Now, assets are broken down into current assets and long-term assets on the balance sheet. Current assets typically mean short-term, what we're going to collect in less than a year versus long-term, which is more than a year. That's the beautiful thing, is that when we transfer this AR or accounts receivables over, they'll not only go on the balance sheet to create immediate collateral, also they're in the current category, which is preferable to lenders. And then thirdly, we'll actually turn around and help liquidate those. So here's just a simple example. So let's say that I own a lawn care business. And so I go out and I mow a yard for 20 bucks. I put the invoice on the house, the homeowner's door. He owes me $20. So it's technically an accounts payable for him. It's accounts receivable for me. But what if I don't want to wait around for the client to pay me my 20 bucks? Let's say I sell you or give you the invoice. So now the guy that I cut his yard, he now owes you the $20. He doesn't owe me anymore. Is that legal? Of course, it needs to be documented properly, but sure. Now he owes you. He didn't owe me anymore. He owes you $20. Well, that's a very simplistic example, but we can transfer thousands or tens of thousands or hundreds of thousands or literally millions of dollars of paper of accounts receivable, and it works. It provides immediate collateral, and then we turn around and liquidate that. And when we liquidate accounts receivables, it means we're collecting the money, and as we collect the money, it turns into capacity. So it's another way to build capacity to get those deposits coming in. So I couldn't fit all this on one page, so let's scroll down. What are our next steps? Well, certainly we want to get back together next week for week 4. We know that, but more immediately, we need to work with you to assist you in assessing your 3 C's: your business's credit, your business's capacity, and your business's collateral. And with that being said, we'll assess it, and then we're going to develop a plan to strengthen it if needed. And we actually gave you, if you go back and notice, we gave you how we'll go about the assessment process because it's important for you to know. We're going to assess it based upon looking at the business credit profile of the business. We said how that's done. From a capacity perspective, we can look at the bank statements, financials, and projections of the business. And if we need to strengthen those, we can legally and ethically. And from the collateral perspective, we're going to look at your balance sheet, or you may need help creating one, which is fine. We can help you with that. And then making sure that you have assets on the balance sheet. In general, and it varies, but in general, for collateral, many lenders will want dollar for dollar collateral. So let's say you want to borrow $1 million, which, well, let's use that recent $5 million deal that we just did. So he wanted to borrow $5 million, not $1 million, $5 million. In his case, he did not have enough collateral for the $5 million. Most people wouldn't. So we were able to legally and ethically transfer to him $5 million of accounts receivables to put on his balance sheet. So mission accomplished there. And then from there, what we'll do is then start liquidating those receivables to turn that AR into really cash. Now, will we collect dollar for every dollar owed? Will we collect? No, that's too good to be true. But we can collect a good part of that. That creates a lot of new capacity. So with that being said, we need to connect with you. You can see, I'll just scroll it here so you can see the first page and second page. Please reach out to us. We need to schedule your one-on-one. We should have been doing this after each of the weekly sessions, but now it's mission critical because we're almost done with the 4 weeks. So you'll schedule a call or call us, and we'll get a call scheduled with your advisor, and we'll assess where you're at, develop a plan to improve if needed, and get ready for week 4. So thanks, everyone. We'll see you back next week. Talk to you soon. Bye-bye.